Imagine you're standing inside a shiny dealership. You spot the perfect car, the salesperson smiles and asks just one question. How much do you want your monthly payment to be? Not, what's your budget? Not, how much do you want to spend? Just one number, $300, $500, $700. Suddenly the car that looked impossible now feels affordable. Because your brain stops thinking about the total price, it starts thinking about one small monthly bill. You leave convinced you made a smart financial decision, but here's the problem. The payment you agreed to wasn't designed to reveal the cost. It was designed to hide it. Everything changes once you see the machine underneath. A car payment doesn't tell you what the car costs. It tells you how long you'll be paying for it. Most people think a car loan is just borrowing money. It isn't. There are several different machines hiding behind that monthly payment. First, the short loan. Higher monthly payments, less interest. You own the car sooner. Second, the long loan. Lower payments, much more interest, more years before the car is truly yours. Third, the zero down payment loan. It feels amazing on day one, but now you're financing almost everything, including taxes and fees. And finally, the trade-in cycle. You never actually finish paying. You simply roll yesterday's loan into tomorrow's car. The payment stays. The debt grows. Different loan, same illusion. Small payment, huge commitment. You think you're buying a car. You're actually buying an entire financial package, the vehicle, interest, registration, insurance, fuel, maintenance, repairs, tires, depreciation, parking, cleaning, unexpected breakdowns. Think about buying a cup of coffee. If someone told you the coffee cost only $1, but forgot to mention the cup, the lid, the tax, and the delivery fee, you'd feel tricked. A car payment works the same way. The payment is just the coffee. Ownership is the entire receipt, everything. Let's say the car costs $30,000. You make a 10% down payment, or $3,000. You finance the remaining $27,000. The monthly payment looks manageable, around $500. That sounds reasonable. But after 5 years, you've paid back roughly $33,000 on the loan. Now add insurance, maybe $1,200 each year, fuel, perhaps $1,800, maintenance around $900, registration and miscellaneous costs another $400. Suddenly, the yearly cost of owning the car is far larger than the payment you focused on. That is the math. So where does your money actually go? It starts with the manufacturer. They build the vehicle, then the supplier network, steel, glass, rubber, electronics, thousands of individual parts. The dealership earns its margin selling the vehicle. The bank earns interest financing it. The insurance company collects premiums. Fuel companies earn every time you fill the tank. Repair shops earn as the vehicle ages. Parts manufacturers earn when components wear out. Parking operators earn. Governments collect taxes and registration fees. Every mile you drive sends money somewhere. Owning a car isn't one transaction. It's an entire economic ecosystem. Here's the biggest surprise. Many dealerships don't make their largest profits from selling cars. They often make far more through financing, warranties, service plans, maintenance packages, and trade-ins. The vehicle gets you through the door. The financing keeps you paying long after you drive away. The car is the product. The payment is the business. Cars also carry costs nobody advertises. Depreciation. A brand new vehicle can lose a significant portion of its value in the first few years. Unexpected repairs, a single mechanical failure can cost hundreds or thousands. Interest keeps accumulating. Insurance premiums can rise. Fuel prices change. Life changes. Lose your job. Move cities. Start a family. The payment doesn't care. It still arrives every month, every month. So what separates people who build wealth from those who stay trapped in car payments? It's not income, it's not the brand they drive. It's one decision. Whether they buy based on price or based on payment, people focused on price negotiate the entire deal. People focused only on payment can end up paying for a car long after the excitement disappears. That's the payment trap. A lower monthly payment often feels like a better deal. Sometimes it's simply a longer obligation wearing a smaller disguise. Let's compare two buyers. Both choose the same $30,000 car. Buyer A focuses only on the monthly payment. He stretches the loan, adds extra products, and keeps the payment around $450. Buyer B focuses on the total cost. He makes a larger down payment, chooses a shorter loan, skips unnecessary add-ons, and finishes paying years earlier. 5 years later, both drove the same car. Both reached the same destination, but one quietly spent thousands more, simply because the monthly payment looked comfortable. Think back to that dealership. The salesperson never asked how much you wanted to spend. They asked how much you wanted to pay each month. Because once your attention moves from the price to the payment, the real cost becomes much harder to see. The monthly payment isn't designed to show you what the car costs. It's designed to hide what ownership really costs.